This podcast is brought to you by East Spring Investments Berhad.
Bank Negara Malaysia has cut the OPR by 125 basis points year-to-date 2020, and we expect monetary policy to remain accommodative due to, number one, a sharp contraction in domestic economic growth. That is, the second quarter of 2020 GDP growth of negative 17.1% is the worst over the last 32 years. Number two, uncertainty in global economic and financial conditions, as well as weakness in commodity-related sectors. And number three, headline inflation is expected to be negative in 2020. The good news is, in terms of debt market, there is adequate liquidity in the financial system. Net government bond supply expected to be higher by Ringgit 48 billion due to fiscal stimulus. Bank Negara Malaysia has released Ringgit 46 billion of liquidity by reducing the statutory reserve requirements by 100 basis points to 2% and allowing financial institutions to recognize MGS and GII as part of their reserve requirements. On the corporate bond front, issuance volume has been relatively muted as corporate access their funding requirements in a weak demand environment. We expect demand for corporate bonds to remain decent due to scarcity of quality corporate bond supply, as evident by the strong bid-to-cover ratio for recent primary corporate issuances. Malaysia government bond yields have increased recently due to weak demand in primary government auctions. There isn't much selling pressure, but the market is weaker due to increased government bond supply to finance the stimulus program, and lately there has been a pick up in the corporate issuance as well. With the recent weak export number and increasing number of COVID-19 cases, we would not rule out the possibility of another rate cut in the near future. Despite the recent cut implemented by Bank Negara Malaysia, MGS yields are roughly where they were in February. That is, despite the low interest rate environment, Malaysia bonds are offering attractive real returns.